Hello and welcome to our latest urgent market update video brought to you by the Live Trade Room. Now today is Tuesday the 11th of October, and really the whole point of this little short video is just to discuss whether there is more downside. Can we expect more downside in these markets as we await US inflation? So let's get straight into it then. If we could start as always with our risk warning, just be broadly mindful of the risks involved in trading financial markets. It's from our preservation of our risk and the capital we have available is the platform from which we as traders can be consistently profitable. So please see our risk warning currently up on screen. Okay, so let's get straight into it then. So let's bring up, we'll just discuss very briefly the fact that we have, I'm going to come back to a couple of important news events over the last couple of weeks, which you will need to be mindful of. However, today now is Tuesday the 11th, and tomorrow, Wednesday the 12th of October, we have US PPI numbers down here. And we're expecting a slight increase in terms of the costs for producers. Now, that can be an underlying driver of inflation, so that's the first thing to note. So we're expecting a positive 0.2, but more importantly, the US economy is a consumer-driven economy. And we are looking at, I'd say it's probably best to describe it as mildly softer inflation numbers. So we've come off the 9.1 highs, as you can see here, 3 months ago. So we're certainly not as high as we were 3 months ago, but we're certainly not weakening as quickly as this market would expect. So we're looking for a number in and around, this is headline inflation now, around 8.1%, with core CPI probably, it looks like it's kind of softening ever so slightly. So really, as always, we're looking for the strong, we're looking to see whether the actual numbers as they get released are in line with expectations or way above or below expectations, and that's what really will define what direction these markets are likely to move. So before we go into the charts, I just want to take you back perhaps a couple of weeks, over the last couple of weeks, and show you a couple of very important news events. The first one being the Fed's own inflation figure, and that is here. It's called the core PCE price index number, and previously month on month it was 0.0, so it was flatlining to a certain degree. The markets were expecting a decent upside number of 0.5, so certainly an upside on the previous month, and it came in above that. So what this meant from a Fed perspective is actually inflation. If we look at the PCE price index number is more of a personal consumption number, and we're actually seeing inflation across this number, as you can see. So that's the first thing to just take on board, is that as far as the Fed are concerned, inflation is marginally ticking slightly higher. The next number to draw your attention to, I suppose, is the jobs number. We had a JOLTS job openings number coming in, probably 1 million jobs less than what was anticipated. So there's probably a little bit of softening on that basis. But look at ADP numbers. These are your employment numbers, these are private sector employment numbers coming in above expectation. And this is the thing, do these numbers come in line with the market expectations, or do they come in above or below? So ADP came in above, and the all-important non-farm payroll also came in quite significantly above as well. So we're looking here at this non-farm employment number, and we can certainly include the unemployment rate as well, coming in above expectation, which is why these are green. So we're expecting 248,000 jobs to be added to the US economy. We actually saw 263. The unemployment number we're expecting 3.7. We actually saw a 3.5 number there as well. So the Fed are not having the impact that they would anticipate at this particular point in proceedings. And that's a bit of a problem because, as you know, the Fed have been increasing rates at a very significant level And if we look down here on the left-hand side of this screen, we've got current US interest rates at 3.25. So what all of this information means as we approach these CPI numbers is that the Fed are under a little bit of pressure. What we can also include within this analysis is what's going on with the bond markets. So whether it's the 2-year or the 10-year US Treasury note, we're seeing quite an elevated upside in this market in the build-up to these CPI numbers. So the Fed are under pressure. They're under pressure with regards to higher than expected inflation with their PCE numbers. We've got a really strong jobs market, which again, the Fed are looking for more weakness. We have, let's say, stuttering growth. So these are the conditions for stagflation, which the Fed should be very concerned about. As we go into these PPI numbers, we're expecting marginal upside as far as inflation for producers and inflation for you and I in terms of the consumer. We're probably expecting a soft, a very, very soft inflation number. So the question is, what next, and what are we likely to see off these numbers? Well, unfortunately, we have to wait for the actual news event itself. If the PPI come in above expected, so it's higher than 0.2, we'd probably expect some downside moves across these indices. The same situation for headline inflation and core CPI. If they come in above expectation, we'll experience what we saw last time, which is we were expecting 8.1 last time, we saw 8.3. So that means it's uncomfortably maintaining its level around that sort of 8+% level where the Fed want to have a big impact. So we are really focusing on whether these employment numbers, these inflation numbers are going to be worse than expected or higher than expected. That's the important thing that we're going to be looking for, to see whether the Fed rate hikes are actually beginning to kick in and having a material impact. It's no use having US interest rates at 3.5 or 3.25 if inflation's up at 8%. That's not really the Fed getting ahead of this inflation story. It means actually they're way, way, way behind the curve because they were so late to the party. They were still printing 120 billion and injecting it into the US economy every single month this time last year, when inflation was already beginning to squeeze higher, and there were some concerns that if they kept printing, it was only going to create a problem further down the line. We're now at that problem further down the line, so we need to take that into account. So just to conclude, if we get inflation numbers that are above expectations, then we can probably expect to see markets like the US indices actually break below the monthly low and break below that very important 35.80 level, which is a strong level of support for this market. If we break through that support to the downside off the back of stronger than expected PPI and CPI numbers, then expect a big move to the downside. The opposite can also be said. If we actually see inflation numbers that are much higher than expected, then much lower than expected, and perhaps there's this perception in the market that the Fed are actually getting on top of this inflation story, then we've got a double bottom here and we've got a potential short-term buy trade. So either way, it is worth waiting for these PPI numbers. It doesn't look like we're going to get much price action between now and tomorrow's PPI, and then on Thursdays, the CPI numbers. But this will hopefully set you up for what we would perceive as some really great trading opportunities. So to just sum up those trading opportunities, we're certainly going to be focusing more so on US indices further to the downside. There's a lot of people saying that these markets, the Fed will pivot, all of that type of stuff. We're not really in that camp just yet. The Fed have an awful lot of work to do. And if we listen to the Fed themselves, we will absolutely see that that's the case. Also, we can look for further dollar strength, despite what currencies are looking to do, like intervention from the yen. It's having very little impact if you look at markets like the dollar yen. So they're still making new highs. So we can, for now, expect further upside as far as the dollar is concerned. You just got to be a little bit more selective on those trades. And we can probably keep an eye on the yen itself to see if we will get some further yen buying, especially if the BOJ wanted to step in. So we're looking for short-term upside perhaps in the yen, but we've got to be selective. We've got to be careful about those types of trades. Great stuff. So that just concludes this particular urgent market update video. If you do have any questions about anything covered, do feel free to email us at support@thelivetraderoom.com. And myself, one of my colleagues, will get back to you as soon as we possibly can. So look, thank you very much for joining us as always. Do stay tuned for our next video. We'll get this sent out to you. We do broadcast our live trade sessions every morning from 7:30 for our early morning trade plan session. And we trade live at 8 a.m. for the European Open, and again at 12:45 p.m. These are all UK times for our US trading session. So if you are interested in learning how to trade, you're very welcome to join us, become a member of the Live Trade Room. For more information, just go to thelivetraderoom.com and we'll be happy to answer any questions you might have there. So for everyone here at the Live Trade Room, take care and we'll speak to you next time. Bye for now.